So as I mentioned, supercharged 57. Let's have a look at the market update in Australia and New Zealand. I'll go through Australia first. Australia housing downturn broadened through October, with every capital city and the rest of state region, apart from South Australia, recording a drop in housing values last month. So the pace of the fall has eased over the past 2 months across Sydney and the past 3 months in Melbourne, but has gathered momentum in Brisbane, where the bum is falling out of it. I'm only joking, didn't say that, I added that. Where home values are now falling the most rapidly of any capital city of the rest of the region. Tim Lawless said it is probably still too early to claim the worst of the decline phase is over. So it's just a little bit too early to state that. Despite the easing in the pace of decline, with Australian borrowers facing the double whammy of further interest rates hikes along with persistent high and rising inflation, there is a genuine risk we could see a rate of decline re-accelerate as interest rates rise further and household balance sheets become more thinly stretched. To date, the housing downturn has remained orderly, at least in the context of the significant upswing in values. This is supported by the below average flow of new listings that is keeping overall inventory levels contained. There are also tight labour market conditions and an accrual of borrowing savings and larger than normal cohort of fixed interest rate borrowers who have so far insulated from rapid housing values across most of the broad regions remain well above pre-COVID levels, implying most homeowners remain in a positive valuation position relative to the purchase price. So summarizing that, yes, the downturn is still very strong in most cities, capital cities, and regional as well, except for South Australia. However, obviously the stock inventory slow coming to market has sort of slowed that down, and of course we're still eating away at that boom sort of growth. So it's not, we haven't kind of gone through that that money that most people made through that boom. Combined capital city minus 6.5 following a 25% rise through the upswing. So we've still got a lot to get through there in combined capital cities. So obviously remaining cyclical highs is Perth and Adelaide. So they still, everything else is showing slower and lower sales. So Perth and Adelaide are still showing quite high sales, but the rest are showing low sales. House values have continued to fall at a faster rate than unit values across the regions. Housing negative 1.2 and compared to units at negative 0.7. And that's relative to the growth that the units had versus the housing. So it is very relative.
Sorry, Ron, is that Perth or across Australia?
This is across Australia, yeah. Through the upswing, capital city house values increased by 29%, which was more than double the rise of units, which is 13.2. So there's the relativity right there, since peaking in April. Okay, so you're looking at combined capital cities, negative 1.1 for the month, negative 4% for the quarter, and negative 3.1% for annually, so the last 12 months. Regional 1.4, so that's actually dropping faster than capital cities now. Quarter 4.1, but still showing a growth of 6.6 for the 12 months because we haven't seen those continuous declines. Nationally, 1.2 negative, 4.1 for the quarter, and annually minus 0.9. Okay. So just to point out Perth there, we're still very minorly affected, still the same as last month, 0.2 minus 0.7 for the quarter, and still showing a 4% growth. Adelaide's still going along pretty well, definitely behind us. 0.3 for the month, 0.6 for the quarter, but they're still showing a 16.5% growth for the 12 months. Brisbane's still showing an 8.4% growth for the 12 months. But Sydney, Melbourne, negative 8.6 for the 12 months and negative 5.4 for Melbourne, respectively. So interesting to see kind of just a follow on from what we mentioned last month and the month before, but also noticing that it's certainly not crashing. Inflation is still up, and that's caused because of the sort of, what do you call it, labor markets, the tight labor markets forcing wages up in a time where our sort of property prices are being forced down. It's quite a crazy kind of thing that's happening at the moment, but thank God it is, because otherwise we'd be crashing. All this, nationally would be crashing. Okay, so the flow of new listings started to trend higher in October, but the traditional spring selling season remains well below levels the same time last year and relative to the previous 5-year average. Over the 4 weeks ending October 30th, a number of newly listing capital city dwellings was tracked at minus 25% below this time last year. So can't compare to this time last year, but if you wanted to compare it, listings, so number of newly listed dwellings were negative minus 25.2% below a year ago, and almost 19% below the previous 5-year average. Okay, so stock levels are frightfully low, and that's nationally. The number of freshly advertised properties is probably helping to contain price falls to some extent, as I mentioned. Okay, sales were minus 16%, minus 16.6% lower than a year ago. So this is sales, not listings. Sales were minus 16% lower than a year ago. Okay, and 3.8% above previous 5-year average. So we're still 3.8% above the 5-year average of number of sales this time of the year. So there's a positive there. There's a definite positive there. The number of lowly advertised properties is I mentioned that. The number of home sales is well down from the highs of last year. However, the fact that sales activity is still above a 5-year average over the past 3 months reflects the base level of demand remains for housing. So there's still a reasonably high demand. Housing, okay, so upgrades, downsizes, movers have been the most resilient sector of the market. Okay, let's have a look at the rental market. National rents rose another 0.6% in October, led by a 1.1% rise in unit rents, while house rents increased by 0.5%. Demand for medium to high density styles of accommodation, such as units, are high, and that's from overseas migration and renters reaching affordability ceiling and looking for cheaper rents. Damo, how are you, mate? Welcome. Thank you. No probs. Renters are reaching affordability ceiling. Capital city rents have risen 17.7%, and regional rents are up 25.5%. High density sector where renting is cheaper is a factor. As rents continue to rise and dwelling values generally trend lower, gross rental yields remain on a rapid upward trajectory. Another positive we can take out for you in the investor sector. Capital city gross yields 3.43 are now the highest levels since November 2020, after rising 47 basis points. Regional yields are substantially higher than gross yields across the combined capitals at 4.4% for houses and 3.4% for units, respectively. So the investor market is looking a lot more attractive, even in capital cities. obviously because of those increases in rental growth. Housing values are likely to continue trending lower until interest rates find a ceiling. At the low end of these factors, a 3.1 cash rate implies an average variable owner-occupier mortgage rate of around 5.21 for new borrowers and 5.69% for existing borrowers. Okay, so what does that mean? That simply means that when people are getting their finance, they are going to be means tested at a higher interest rate. New Zealand has gone ballistic. Their means testing is going to be, I'll explain in a second. So a lot of changes in the market. Although housing risk remains skewed to the downside, there are a few tailwinds that should help keep this downturn orderly and stave off material rise in distressed listings. And these are what's holding it together. Tight labor markets, as I mentioned, net overseas migrations, which I've mentioned, persistently tight rental markets and rising yields, which I've mentioned, housing savings and history of higher than required mortgage repayments should also provide a buffer to higher mortgage rates and cost of living pressures. You know, a lot of people have cottoned on to the quicker I pay off my mortgage, the less I've got a mortgage. And that also buffers them from, mortgage stress and higher interest rates because they've got a kind of buffer there. So that's happening. The silver lining to falling home values is more affordable entry point to the market for buyers. So now we're starting to see more affordable housing, especially for first home buyers, which obviously encourages the market again. So I think we're definitely nationally getting towards the end of, the kind of doom and gloom kind of position that we're in. I don't think we're quite there yet. I think because if they stop, this is the problem. Inflation's, I wouldn't say it's still out of control, but the staff shortages are causing people to say, I can go and get another 10 grand down the road, or 20 grand down the road, or 5 grand down the road. And then the sort of employers are having to pay more. And then what are they doing with that extra cash?
Paying off interest.
Spending it. And that's inflation. Inflation is spending, and everybody's spending money. Why is everyone spending money?
Locked up the nation for 2 years.
That's one reason. Why else?
Earning more. They had lower interest rates. They had lower commitments before.
Yeah. So now they've got extra cash. So they're spending more. It's simple. That's where the inflation's coming from. So obviously buyers are back in the driver's seat, which they have been for a while in most states and territories. I wouldn't say that they're completely in the driver's seat here in Perth, but they're definitely gaining momentum. And certainly Brisbane, Sydney, and Melbourne, they're well and truly in the driver's seat. Adelaide, not so much. For vendors, homes are taking longer to sell. Auction clearance rates generally below average, and vendor discounting rates have become more substantial. That's the report on the Aussie market. Just before we go to everybody, because we do have some New Zealand clients, their position is just a little bit worse than ours on a national basis. And the simple explanation is that they had a bigger boom and for slightly longer. So what goes up must come down, and that's kind of where it's at. So I just pinpointed a few things for them. October, negative 1.3% nationally, down September, negative 1.5% in September. So Optimus is likely to be cut short. That's actually slowed down the downturn for them by 0.2%, but optimism is likely to be cut short because the official cash rate has been increased. Affordability stretched, increased mortgage, stringent serviceability is their major issues. Serviceability test rate is now already above 8% in New Zealand. So if you want to get a loan, that means testing you on 8%.
That's what they're doing here as well.
I thought ours was 6%.
Okay.
Yeah, not quite. We're not quite there yet.
Mid sixes.
Sorry.
Mid sixes.
Okay.
Mid-5 a month. I did mention it. At a low end of the forecast, the 3% cash rate implies an average variable owner occupier rates of around 5.21% for new borrowers and 5.69% for existing borrowers. So, but they probably will means test you for a little bit more, so it might be in the 6%. But here we're talking 8%, which I thought, okay. Compare unfavorably following the global financial crisis in 2008. They're comparing it to that. October of negative 4.5 now exceeds the worst quarter from that period. So even worse than the global financial crisis, they've seen downturns. The annual fall has grown to minus 13%, extending the record for the region first broken last month. That was Wellington. So don't need to go into too much specifics. A couple of other interesting things. All banks have revised their housing price forecast down to the wake of the latest data. And if we assume an 18% fall from peak to trough, that would take the average price to $855, still a lot higher than March 2020. The average value prior to the pandemic hitting our shores is February 2020 was $723. To get back to the value would necessitate a 31. So they've also still got a buffer because of their huge bloody boom that they had. Finishing off with New Zealand's, time will tell whether the latest data releases and upcoming decisions are complementary, will be enough to rein in spending and encourage more saving to produce a meaningful reduction of inflation. That's the market in Australia and New Zealand. How do we see that?